Would you rather buy a stock with 4% yield or the exact same stock with a 6% yield? That's the choice Tariffs just created for us. The companies haven't changed. Their dividend hasn't changed. The only thing that changed is that you can now buy future income at a massive discount. Take AT&T for instance. It's paying a $1.11 annual dividend. And before the crash, it was trading at $28. That's a 3.88% yield. After dropping almost 7% to $26, new investors are locking in a 4.17% yield. Same dividend, same company. But now you're getting 7.5% more cash flow on every dollar you invest today. Or look at Enterprise Products Partners. It pays a $2.14 annual dividend. At its previous close of $33, it offered a 6.4% yield. After crashing nearly 8% to $30, you're now getting a 6.94% yield. That's 8.4% more income for doing absolutely nothing except buying after the dip. That's the power of buying great dividend companies when others are panicking. Red markets aren't something to fear. They're literally the best possible time to put new money to work. But before I reveal which dividend sectors are actually immune to these tariffs, let me clear a couple of things for you. First, the media wants you to believe tariffs are Armageddon. They're not. So do not panic sell your current holdings. Second, the fundamentals of strong dividend companies don't change overnight because of a tariff announcement. The cash flows, the payout ratios, the dividend growth, none of that changes in a week. What changes is market sentiment. Weak investors panic and sell quality companies at a discount. Smart investors buy those discounts and lock in higher yields. That said, let's get into which dividend sectors are actually immune to these tariffs, because some of the best income-producing assets aren't impacted at all. Number 1, energy. The White House confirmed it in the executive order. Energy products are exempt from Trump's tariffs. Let me repeat that. Exempt. That means energy companies, some of the highest dividend payers in the market, won't see their costs increase. Look at companies like Exxon, Chevron, and Enterprise Products Partners. These aren't just dividend stocks. They're dividend aristocrats. They've been raising their payouts for decades. And now, with their share prices down because of market-wide panic, their yields are through the roof. Exxon was yielding 3.52% at its previous close of $112.40. Now, after dropping 7.2% to $104.34, it's yielding 3.8%. That's instantly more income on every dollar you invest. Enterprise Products Partners was already yielding 6.4% at its previous price. After this drop, it's now at 6.94%. This isn't a disaster, it's a gift. And here's what makes energy dividends even safer. These companies are swimming in cash flow. Oil prices are stable. Natural gas demand is growing. Production costs are under control. The fundamentals haven't changed at all. Only the share prices have. When you see a disconnect like that, you pounce. Number 2, REITs. Real estate investment trusts just went on sale, and most investors don't understand what they're missing. Yes, some retail REITs might face pressure from tariffs. But do you know what most REITs actually own? Service-based properties that won't be affected by import taxes at all. Take NNRI. Everyone's worried about their retail exposure. But look at what they actually own. Fitness centers, movie theaters, car washes. None of these businesses sell imported goods. They sell services. Tariffs don't affect them directly. The same goes for healthcare REITs, data center REITs, cell tower REITs. These aren't selling physical products from China. They're collecting rent from recession-resistant tenants. But their share prices are down 15 to 20% across the board because of market-wide panic. Do you know what that means? Their dividend yields just exploded higher. Healthcare REITs that were yielding 5% last month are now yielding 6 to 7%. That's a 30% increase in your income stream for every dollar you invest today. And here's the part most investors don't understand. REITs are legally required to pay 90% of their taxable income as dividends. They're dividend machines by design. When you can buy these dividend machines at a 20% discount, you're setting yourself up for massive income growth. Even during the 2008 financial crisis, many REITs maintained their dividends. If they survived that, do you really think Trump's tariffs are going to break them? Smart investors are backing up the truck right now while everyone else panics. Number 3, business development companies. Business development companies are the dividend investors' secret weapon during market panics. These alternative lenders provide financing to middle-market companies, and they pay out massive dividends, often 8% to 12% yields. And right now, these yields are getting even bigger thanks to tariff fears. Here's what most people don't understand about BDCs. They primarily lend to service-based businesses, not retail companies. Look at Ares Capital, the largest BDC in the market. What's in their portfolio? 25% software services, healthcare services, asset management, senior direct lending. These aren't businesses that import physical goods from China. They're service providers that generate steady cash flows. The same goes for Blue Owl Capital. Their loan book is filled with recession-resistant businesses that generate consistent income regardless of tariffs. But because the entire market is selling off, BDC share prices are dropping 10 to 15%, which means their already massive yields are getting even bigger. A BDC that was yielding 9% 2 weeks ago might be yielding 10 to 11% today. Think about that, over 10% annual cash flow on your investment. Where else can you get that kind of return with this level of quality? And while BDCs might have their share prices fall with the broader market, their dividend payments are secured by contracted loan interest. BDCs also benefit from rising interest rates. When rates go up, so does the interest income they collect on their floating rate loans. This directly translates to higher dividend payments to shareholders. So while the market panics about tariffs, BDCs are quietly producing record cash flows. Now, let's talk about the sector that's causing the most panic: consumer staples. Yes, companies that sell physical goods imported from China and the EU will face cost pressures. But does that mean all consumer dividends are at risk? Absolutely not. First, many retail companies have already announced they'll absorb the tariff costs themselves rather than passing them to consumers. Yes, this might squeeze margins temporarily, but it doesn't automatically threaten dividends. Companies like Walmart, Target, and Costco have plenty of free cash flow to maintain their payouts, even with slightly lower margins. Second, not all consumer companies are equally exposed to imports. Look at companies like McDonald's or Starbucks. They source most of their ingredients domestically. Their dividend payments are rock solid. Even for companies that do face tariff pressures, remember this: dividend cuts are a last resort. Management teams know that cutting a dividend triggers a massive stock sell-off. They'll cut everywhere else first: share buybacks, capital expenditures, marketing budgets, before touching that sacred dividend. And here's the part most investors miss. Many consumer staples companies have maintained or increased their dividends through multiple recessions, tariff wars, and market crashes. Procter & Gamble has raised its dividend for 67 consecutive years. Coca-Cola? 62 years. Do you really think Trump's tariffs are going to end that streak? If yes, comment below. This is why dividend investors sleep better at night. While growth investors are having panic attacks about tariffs, we're counting our cash flow. When you own quality dividend payers, market volatility becomes your friend, not your enemy. Think about it. If you're relying on share price appreciation, market drops are devastating. But if you're building a dividend income stream, market drops are buying opportunities. Every time prices fall, your future income potential rises. That's the power of dividend investing. You don't need a market to go up to make money. You get paid while you wait. And during market crashes, you can accelerate your income growth by locking in higher yields. Here's another advantage. Dividend stocks are inherently more stable during market panics. Why? Because the dividend itself provides a floor for the share price. If a company's yield gets too high, income-hungry investors step in and buy, stabilizing the price. You don't see that mechanism with non-dividend stocks. And here's the most important part. Dividend investing is about growing your income stream, not obsessing over day-to-day share prices. If your dividend payment grows 10% per year, do you really care if the share price temporarily drops 15%? Of course not. You're playing a different game altogether. If you're nervous about picking individual stocks during this tariff panic, there's a simple solution. High-quality dividend growth ETFs. These funds give you instant diversification across dozens or hundreds of dividend payers, reducing your company-specific risk. Funds like SCHD, Vanguard's dividend ETFs, iShares DGRO, or Fidelity's FDV have proven track records of delivering growing income streams through all market conditions. They own the strongest dividend companies across multiple sectors, balancing your exposure. The best part? These ETFs just went on sale. Their share prices dropped with the broader market, which means their dividend yields increased. You're getting more income for every dollar you invest today compared to last week. And because these funds are professionally managed, they automatically adjust their holdings to maintain dividend quality. If a company's dividend becomes at risk, they'll sell before it affects the fund's payout. It's dividend investing on autopilot. For long-term investors, these dividend ETFs are the ultimate sleep-well-at-night investment. No matter what Trump tweets, no matter what new tariffs get announced, these funds will continue paying and growing their dividends year after year. I hope I change your mind to stay positive on dividend stocks. That's it for today's video. Stay invested, stay patient, and as always, take care. I'm Andrew, and I'll see you in the next one.